You won't believe what Michael Burry just predicted. Well, let's have a look. Like and subscribe.
Burry of the Big Short fame is out with a statement that...
I hate him. I hate him so much, Michael Burry. Now I remember. The Big Short is complete fiction. The guy is deep state propagandist. But let's hear what he has to say.
Thinks the stock market is near a top, and in fact, in his words...
You know what? Gravity makes things fall. The sky is blue. Yes, of course the market's near a top.
There's a risk of a crash of an 87 style correction in the marketplace. Now, I'm down here in St. Bart's at Hugh Hendry's Acid Capital Summer Camp Retreat, which is a terrific time, by the way, and I recommend everybody come here if you can. And one reason why is you can talk to some very successful traders, portfolio managers, investors about exactly what we're going to talk about here. And I got to tell you, the sentiment here is very similar to what Michael Burry says. Now, to be fair, when I was here last year in August of 2025, they all expressed the same sentiment. But there is a key difference this year to last year, and also what connects what we're talking about, the stock market and potential downside, to 1987, and that is the credit market. The credit market cycle is different this year than last year, which raises the dangers in the stock market. Yes, the credit market and the stock market do bear some resemblance. They do have some relationship. So let's talk about the risks in the stock market as it pertains to the different...
What is it that always the disclaimer in financial documents? Past performance is no indication of future performance. Just because earnings are good now, they were good in 2008, in the first half of 2008 in some companies, before they stopped being good.
Differences in the credit cycle, and we've got potentially another cockroach in the credit cycle downturn that is starting to emerge in a very familiar place. So Michael Burry says he's going to bet against this rally, even though the S&P is hitting new record highs. He says we're near a major top and a possible 1987 type of fall. No one is going. In fact, no one is going to be able to predict the top, and there's still potentially some upside left. However, again, like I said, this is a sentiment that we keep coming across time and time and time again. Just nobody is willing to bet against it just yet. This is where the credit market and the credit cycle really comes into play as it pertains to sentiment, first of all, because when the credit cycle shifts, what that says is risk-taking behavior starts to really move in a different direction. But also money flows. Money flows are important on some level. But really, when the credit cycle turns, that makes everybody take a second look at risk assets in a broader fashion in general. And as I talked about in yesterday's video and previous videos not that long ago, private credit is only the beginning here, very likely only the beginning.
And it's going to be exacerbated by high oil, gas, diesel prices.
To see the credit cycle overall touch very different parts of the credit markets, not just private credit, not just cockroaches in private credit, but also, as we'll see here, public credit spreads and junk, but also investment grade, hyperscalers, AI. Basically what I'm saying here, and what I think Michael Burry is saying, as we'll get to in a second, is that everything is really connected. And when everything is really connected and the situation really starts to turn in one part of it, the chances of it really spilling over across all of these risky asset markets really goes up. And I think
that's true. And a shock, like an oil price shock, that stresses the entire financial system. And so if there's any part of the financial system that is vulnerable, that is weak, it will go under, and it will start to drag the other parts of the financial system down with it. Contagion. Like what happened in 2008. It began in subprime market and spread to nearly everything.
That's what's Burry's message. And again, I'll say it again here, down in St. Bart's at Hugh Hendry's thing, that is the sentiment widely shared among not just veteran traders, but...
Yeah, if we have someone the size of Bear Stearns collapse, like in 2008, we would have a catalyst for a major fall. Yeah, there's going to be someone that has a exposure to private equity fund that bet heavily on low price oil that's going to go under and it's going to hit a bank. Or it could be that... someone gave too much money to subprime borrowers in terms of credit cards, and then there's an oil price shock and gas prices go up and delinquencies soar in the subprime sector. There's many vectors for things to go wrong right now.
Really good people who know how to invest money. Again, they'll never say I'm going to call a top, but you can see the risks of one rising because it looks very familiar. It looks in many different ways like there was one, or like there is one that's starting to emerge from the marketplace. So like Burry says, I continue to believe it's possible when you're a major top and possible a 1987 type fall. But again, this is a sentiment widely shared. It looks like a top, but making new highs is going to bring new money into the market, new investors into the market. And so the new high could lead to further highs. And we don't really know when this thing will turn around. It'll turn around basically when it turns around. That's really the sentiment that's being expressed. That we know this thing's going to turn around. We just don't know when it's.
Everyone's that's not a great place for the market to be, where everyone expects like a crash, but they just don't know when it's going to happen. Then all you need is the trigger. The trigger being, we have a very good trigger coming in terms of oil shortage, gas shortage. People think, okay, that's probably going to be the trigger, and everyone's going to start expecting a market crash, and that's probably what's going to happen.
Scary. We don't know when it's going to happen or what will be the specific cause for it. However, the background, again, like I said, last year, same kind of sentiment. A year later, stock market's still booming ahead. But the difference this year to last year to the year before and the year before that is the credit cycle.
The big difference is the Iran crisis and the Strait of Hormuz being closed. There was no huge macroeconomic headwind like that in past years. It's going to be a completely different scenario.
We're getting more and more signs that the credit cycle has shifted. And as Burry mentioned in his report here,
catalyst, macro. Well, I believe in this. The market, it might take a while, but it eventually reflects the fundamentals. And this missing oil, that a lot of lubrication from the global economy has disappeared. Eventually, that's going to have consequences.
And the demand for AI infrastructure is being fueled by financing arrangements that may prove unsustainable. That is not just a nod to private credit, but also, again, the credit cycle overall. Now, what do you want to do a little bit of review here before we get into the cockroaches as well as what's going on in private credit today? Let's talk about 1987. Let's talk about the crash of 1987 through the lens of a credit cycle. Now, it was a very short credit cycle in many ways, and it depends on how you date it, but it looked like, from 1981, 82, really the bottom in 82, up until 1987, 86, 87.
It was after this crash that rumors of the plunge protection team started circulating in the media.
Credit cycle was intense and was relatively short by scales that we're used to now. But, 4-year intense cycle where credit growth was absolutely astounding. I'm showing you here domestic bank sector versus domestic non-bank sector for a specific reason. And the reason that I put the domestic non-bank sector in there, which are, pension funds and insurance companies, because this should sound very familiar. A lot of the credit growth, you can see the growth rate got up to around 20% in 86 and early 87. 20% growth.
Yeah, the monthly 401k contributions going to S&P are propping up the market. Well, that's firings matter in that context. And if you have lots of layoffs, I know there have been lots of layoffs in gaming, for example. Every layoff is one less 401k contribution. But you are right. There are always constant streams into the market. But I'll tell you what, back in 2008, there were also monthly 401k contributions. But the market still crashed back then.
Growth rate from non-banks, so shadow banking familiar to the cycle that we're talking about now. Before we even get to 86 and 87, bank credit had started to slow down material. So there was already suggestion that the credit cycle was slowing down at the very least. And as I'll go through in a minute here, in the context of the growing S&L crisis, it wasn't just a slowdown in credit that was emerging. It really was the first stage in the downswing in the cycle. So the crash of 87 is right here on both charts. And you can see non-bank credit.
Oh, yeah. The 2.8 to the bottom there was a great time to buy a house. You are lucky. Anyone who bought like a house in 2009 or very end of 2008, great time.
It's slowing down pretty sharply. Bank credit had already slowed down pretty sharply, but here's the point. If you look
it was in some cases hard to get financing for it. If you could get the financing, it was a great time to buy.
After 1987, 1988 into 89, and then 1990 is a true downswing in the credit cycle driven by banks in the S&L crisis. So by the middle of 1987 to the late 1987, worries about the credit cycle and the health of the banking sector, at least the S&L part of the banking sector, were really starting to emerge as primary considerations across all risky markets. And like I said, the money stopped flowing at the same rate it did. It was still growing tremendously, but second derivatives do matter here. And the credit cycle was already starting to its first phase of the downswing. And there were very good reasons why there were such major concerns about the credit cycle over and above just, potentially some losses and bad lending that might emerge. When you look at
right there, you see that? SNL crisis, savings and loan crisis. And it's funny, This crisis is what gave us the 2008 financial crisis. Oh, I don't know if I've ever showed this to you, Gata Naranja. Let's see. Managing the Crisis, FDIC. Right here on the FDIC's website, Managing the Crisis. And this was the RTC experience. RTC is what dealt with the savings and loan crisis, all the hundreds of small banks that went under. This report is on how they managed that crisis. And where's the PDF? Chapter 16 is called Securitization. And what do you think the RTC did with toxic mortgage security? Here we see. In October 1990, 1 year after RTC was created, a securitization program was established to facilitate the sale of mortgage loans. And we're talking about toxic mortgage loan, subprime mortgage loans. This focus on the creation, development, and performance of this program. This chapter outlines how the subprime market was created. And the 2008 financial crisis was basically the market created by the RTC exploding. They solved the savings and loan crisis by creating a time bomb that exploded in their faces, that nearly took out the financial system. It wasn't Wall Street greed that created the 2008 financial crisis. It was regulators. Yeah. Oh, yeah. The first bundled loans. In this thing, you have graphics for it at some point. Oh, right here. Commercial mortgage loan pass-through certificates. The structure of subprime CDOs. The first ones created by the RTC. That's why I hate, what was his name? Michael Burry, the guy who wrote The Big Short. Because he just says, oh, it was all Wall Street doing it. No. That's complete lie. That book is fiction. It was regulators that created the market. They went out and they are the ones who got pension funds and other institutional investors to buy toxic mortgage securities, these CDOs. They're the ones that figured out how to securitize everything. They're the ones who went to rating agencies. Here we go. Rating agencies evaluate the transaction structure, the underlying pool of assets, and the expected cash flow, and determine the extent of the loss protection that should be provided to investors through various forms of credit enhancement. Securitization transactions typically involve the use of credit enhancement. Remember that from 2008 financial crisis? To create securities that have very high level of quality. The rating agencies have developed loan loss models to estimate the required level of loss protection for a securitized mortgage loan pool. They use the Great Depression, right there, as a benchmark to estimate the level of losses. That doesn't sound right. Subprime mortgages didn't use the Great Depression as a benchmark, so what happened? You could tell that they weren't happy with this, so they came up with their own models. The RTC developed a model to project each transaction termination date and to estimate realized losses. A model was developed. Yeah, right there. They developed this model and forced the rating agencies to use it. And that's how you had the financial crisis in 2008. Basically, it was all regulators. I just had to highlight that.
Over and above just, potentially some losses and bad lending that might emerge, when you look at bank failures by year, the S&L crisis, we started to see a tick up in bank failures.
Yeah, this is what saving and loan crisis. Huge number of banks failing. Some of them failed with toxic mortgage securities. And the way they solved that is they securitized them into subprime CDOs and sold them to pension funds and other investors, telling them they were completely safe. And that then blew up in 2008.
In the early 1980s, but it really started getting serious at 85, 86, and yes, 1987 bank failures for the third consecutive year were into the hundreds, which meant that this wasn't just, a normal credit cycle. A lot of people were concerned that 1987 was going to, the S&L crisis of the mid-80s and then the crash of 1987 combined looked a little bit too much like the Great Depression. Now, that was a mistaken impression about what the Great Depression was really about. However, again, the point here being, by the time you get to the top in the market,
and by the way, what you're saying, I see no issue with toxic assets being sold as long as the price and risk reflected the nature. Yeah, and I'd agree with you. If the rating agencies were still used the Great Depression as a benchmark for evaluating them, and still required huge loss reserves to cover any losses, then there would never have been a crisis in the subprime market. But you see, regulators, they're trying to pay back depositors. They need the cash right away. They can't leave a whole pile of cash to the side in case of potential losses. So they came out with models that were very optimistic and for which there was no need to put cash aside to cover losses. And there we go, 2008 financial crisis.
Market in 1987, the local top or the short run top, intermediate term top in 1987 in the stock market, there were serious concerns about the state of the banking system, the credit markets. That's really the parallel that we need to be paying attention to here. Not the specifics of the crash of 1987, with computer trading and quant and all that kind of stuff, but the combination of equity markets that more and more people are questioning just on the fundamental terms such that they exist in the equity markets of the equity market itself, but also the background behind it, really the money, the serious money, which is in the credit market and the credit market.
By the way, these bank failures here were mostly small banks. And so while there was less total bank failures in 2008, the banks that did fail were a lot bigger. This graph was doing it by the size of the balance sheet of banks, they'd be nearly identical. Fewer banks, but with bigger balance sheets in 2008.
There were very serious concerns about the credit cycle that we're building in the mid-1980s, culminating in the late 1980s with the crash of 87, not coincidentally in the middle of that process because it got caught up in what was a pretty substantial credit cycle downturn. That's really I think the point. I don't want to put words in Michael Burry's mouth, and I didn't see the entire report, but as soon as I saw the connection,
Michael Burry.
That's really what he was saying. It's credit cycle connection makes a huge difference when we're looking at the potential for the stock market to make its top and eventually roll over. So there's the parallel there. And by the way, just to remind everybody, we've got a webinar coming up August 9th, which is this coming Sunday, 5:30 p.m. Eastern time. We're going to be talking about using Eurodollar information. First of all, the webinar we did last a couple months ago, right?
Okay. I think I don't need to see the rest of the video. Point is, we might be heading into another financial crisis next year. And I'm totally willing to believe that with the shock oil shortage is going to give the financial system. But it was a nice throwback to talk about the savings and loan crisis and 2008 financial crisis. Covered that so extensively 15 years ago. Like and subscribe, come watch on Kick or Twitch, and I'll see you next video. Bye.